Welcome to the College Investor Audio Show, where we talk about the biggest issues impacting millennial money, from student loan debt to side hustles to building wealth. We will show you how to get out of debt so that you can build real wealth for the future.
Most websites have chatbots. Car companies are developing real autopilots, and machines now make and repair other machines. Automation has affected large swaths of the modern economy, and everyday investors can benefit from automation too. Robo-Advisors are platforms that use algorithms to automate investments on behalf of clients. They make it easy for investors to do the right things, like automatically. But are they right for you? We explain how robo-advisors work and when they make sense, and also when to avoid them. Today, on the College Investor Audio Show. Welcome! But first, we answer the question, what is a robo-advisor? A robo-advisor is a common name for a technological platform that helps users invest into financial markets using some form of algorithm. Most robo-advisors invest users' money into broadly diversified baskets of stocks, bonds, and potentially alternatives such as REITs or commodity funds. The overwhelming majority of robo-advisors follow a time-tested strategy called modern portfolio theory. This strategy involves investing in low-cost, broad-based index funds, usually ETFs, with a representation of domestic, international growth, income, and small-cap stocks. However, some invest in individual stocks, active mutual funds, or follow strategies outside of traditional index fund investing. Wealthfront and Betterment are probably the best-known names in robo-advising, but there are many, many more worth considering, especially little-known names like M1 Finance. Most robo-advisors offer, some degree of customization based on your age, your risk tolerance, timeline to your goal, all of that stuff, but will do all of the investing on your behalf. When it comes to investing, investors can put money into a robo-advisor platform and know that it is being invested with a goal towards sustainable growth and tax efficiency. Although robo-advisors have the word advisor in them, most robo-advisor platforms don't offer financial planning advice, unless clients pay a little bit extra for it. The financial planning advice is typically administered by people rather than computer programs. That's nice to know. So how do robo-advisors work? The common thread among all robo-advisors is that the platforms operate programmatically. Computers invest your money using some predictable strategy. No human intervenes in the investing, and, unless you pull your money out or you put money in. Most robo-advisors invest your money into ETFs or mutual funds. Whenever you deposit money to the platform, the robo-advisor will buy partial shares of your investments. Periodically, the robo-advisor will sell some of your best-performing assets to buy some of the lowest-performing assets. This is called rebalancing, and it is one of the primary benefits of robo-advisors. Robo-advisors also record all the trades that they do on investors' behalf. This allows the investors to accurately account for gains and losses at tax time. It also allows investors to take advantage of tax loss harvesting rules, which allow investors to lower their tax burden by offsetting their gains with their losses. How much do robo-advisors cost? As robo-advisors become more common, the average price of using one is falling. That's the magic of competition. In general, robo-advisors use an assets under management AUM model of pricing. That means the price you'll pay is a percentage of your total money controlled by the robo-advisor. Prices tend to range from 0.25% to 0.75% of assets under management per year. Quick example, if you have $100,000 under management and a 0.25% fee, you'll pay $250 per year for the robo-advisory services. In addition to the management fee, you'll have to pay fees on the underlying investments in the portfolio. The most prominent robo-advisors use extremely low-cost ETFs or stocks to keep internal costs low for investors. However, the cost of investments is worth investigating if you're considering a robo-advisor. Do DIY investors need a robo-advisor? Robo-advisors provide a useful service to a segment of investors. Investors who have the desire to invest in financial markets but really don't want to worry about the technical matters like learning how to buy funds and manage a portfolio may benefit from a robo-advisor. However, the benefits of tax efficiency are really only important to borrowers with after-tax brokerage accounts. That's a pretty thin slice of the population. Additionally, the benefits of a well-diversified portfolio can be achieved with 2 to 5 broad-based index funds. The basics of investing can be easy to learn, but if you don't care to learn about them, a robo-advisor is a must. Times to consider a robo-advisor. So while they aren't for everyone, investors may benefit from using one though. These are the times to consider it. You don't care to learn about the technical aspects of investing. Learning to invest in financial markets is really not that tough, but you do need to figure a few things out. You'll need to figure out where to open an account, what type of account to open, how to buy investments, and how to keep buying into the market. Over time, you will need to learn about things like asset allocation and portfolio management. Many successful investors use simple strategies, similar to those employed by the robo-advisors on their own. But if you're someone who doesn't really want to learn about investing, you can offload the technical aspects of investing onto a robo-advisor. You're seeking tax efficiency. Yeah, if you've got a lot of money in a savings account or in an after-tax brokerage account, using a robo-advisor can be a financially savvy move for you. Robo-advisors take advantage of tax loss harvesting, which allows investors to sell investments for nominal losses and thereby show losses in their portfolio. This allows the investor to offset the taxes they have to pay on gains. Tax loss harvesting is technically challenging, but hugely profitable for people with large amounts of money in non-retirement accounts. For this type of investor, a robo-advisor can pay off. You maybe want to get started with limited fuss. There's another great way. It can be a great way to dip your toes into the financial markets. The platforms are easy to use, and they help beginning investors avoid some of the big mistakes, like trading too often or being under-diversified. If you have money you want to invest today, a robo-advisor can help you get started. Robo-advisors can stop your analysis paralysis and get you moving in the right direction. Let's talk about some times to avoid a robo-advisor. Maybe you want some to help you stick with your plan. Robo-advisors aren't humans. They aren't going to talk you off the ledge when you want to sell low and buy high. They cannot help you master some of the more difficult aspects of behavioral finance. Financial counselors and certified financial planners are better equipped to help humans avoid the negative parts of, being human. You have a high risk tolerance. Most robo-advisors automatically invest some portion of investors' money into bonds, cash, or similar low volatility options. Most strategically invest a larger share of the money into those safe havens as investors get closer to their goal date, including retirement. If you have a high risk tolerance, or maybe you just need higher returns to meet your goal, safe haven investing might not make sense for you. Be sure to investigate whether the standard allocation and the change in allocation over time makes sense given your appetite for risk. Or maybe you want to actively invest or select individual stocks. Robo-advisors are passive income or investment platforms. Investors who want to select individual stocks or actively manage their portfolios according to certain rules aren't good candidates for robo-advisors. The robo-advisors help users stick to a prescribed path, and that path doesn't involve selecting individual stocks. You're willing to learn about the technical aspects of investing. Most people can easily learn the basics of investing by reading a single book, by starting a short course, or maybe by reading a few articles every day. It's not hard. Knowing the technical basics of investing can keep you from being hoodwinked by nefarious actors. Understanding the basics can keep you from freaking out when you see losses in your portfolio. It can help you develop a plan. Learning about investing in financial markets is pretty easy, but you must be willing to do it. If you're willing and you have the time, of course, you can probably skip the robo-advisors. Your only accounts are employer-sponsored accounts. A lot of people start investing through employer-sponsored retirement accounts like a 401k or a 403b. If you have one of these accounts, you're stuck with your employer's chosen provider until you change jobs and can roll the account to a rollover IRA or your new 401k. People who only have an employer-sponsored investment account don't need to worry about robo-advisors unless they choose to leave their company and want to roll over the account. Is a robo-advisor right for you? DIY investors don't need robo-advisors to become successful, but robo-advisors can be useful platforms. For a modest cost, a robo-advisor can push you towards a tax-efficient, well-diversified portfolio of stocks, bonds, and other financial instruments. Of course, you can get that without the help of a robo-advisor, but you need to ask whether you'll actually do it. I like robo-advisors for people that have struggled to get started with investing. The platforms make it easy to automate great behavior such as investing regularly, rebalancing, and sticking with your asset allocation. Consider your own investing, or lack of investing behavior, and decide whether a robo-advisor can help you improve. That's what it's all about. Thanks for stopping by today, just taking a look a little bit at robo-advisors. You've probably heard a lot about them, so I hope that helps to move you in the right direction of making a decision. Bottom line, invest now in something. Find the best thing for you and stick to it. This is a marathon, not a sprint. If you want more tips, advice, resources, research, you can do it all at thecollegeinvestor.com. Thanks again. We'll talk to you again very soon.